All right, we are connected. This is the Happy House Hunters. This is our free monthly meetup. We are in a series currently doing the 6 F's of real estate investing, and that is finding, funding, fixing, flipping, filling, and finally, what is your freedom number in real estate? So tonight we are on the second module of that series. Last month we did the actual finding, and tonight we are talking about the funding. So I am going to let Brooks start off and tell us about you, a little bit about your background, and then tell us all about your information on funding. And then I'll ask the rest of us to go on mute so that we don't get any interruptions. So with that, Brooks, I'm going to turn it over to you.
Okay, thank you, Kathy. Thank you for letting me be here tonight, and I look forward to speaking with the rest of you. And my background, so I was in corporate America until about 2013. Back in 2009, I started actually investing in real estate. Like many of you are probably in that process right now, trying to figure out how to get out of your corporate job or just how to be full-time or whatever it may be. But so I started out as an investor. I'm still an investor. And then last October, just as I've gone through my investment career, we've kind of branched out into other aspects of real estate. I just started out buying and holding properties, when I had that good W-2 income. The banks were really nice and wanted to give me loans. And then I quit my job and it became a lot harder. And so we've started property management. My partner is a broker, so we have the brokerage piece. And then, like I said, last fall, we just started on the financing side of things. So I have a lot of experience in all the different areas of finance as it relates to residential and commercial real estate. And what I was going to do tonight was talk about really what I see and hear about most of the time from investors that are looking for either fix and flip financing or the single family rentals, or let's call it residential 1 to 4 family. And that's typically, I think, what most of this group is. So there's really three aspects of that. One is private money. I'm sure many of you have heard that word thrown around many times, and you may or may not know exactly what that means. The second is hard money, which my company, Wildcat Lending, is a hard money lender. We are based in Dallas, but we lend in Texas, Tennessee, and now Ohio. So my role is I'm a partner in the Ohio business. I essentially run the Ohio market. I'm local to Columbus, so I know this market extremely well. And then the third piece is really just the more traditional side of lending. And so I'm just going to go through all three of those fairly quickly, and then we'll just do a Q&A. Can everyone hear me okay? Is there it sounds like there might be some feedback. Is that right? No, we're good? Okay.
Everybody here?
Yes.
Okay. Good. So I'm going to start with private money and kind of go through the pros and cons of kind of each of the three types that we're going to talk about. Private, again, it's a very sexy buzzword. You probably hear it a lot. Really what private money means is it just means that you're borrowing money from another individual. And that can mean family, friends, a business referral, whoever that may be. But typically the lender in that scenario is just another private individual. So I may go to Kathy and say, hey, Kathy, I have this great deal. I know you have, 100 grand or whatever the number may be sitting in the bank. You're not getting much in the stock market right now. Interest rates are low, obviously. So would you be interested in funding my real estate deal? And so the advantages of private money are it can be very easy to get if you can find that right person. And the underwriting process or the, kind of the evaluation process is 100% strictly up to the lender. So, that process can be literally all over the board. That can mean as little as, hey, where's your wire instructions? Send me the money. And that's it. Or it could be very strenuous depending on how strict that lender wants to be. The negative of private lending a lot of times is just that it's not very dependable. So Kathy I may call her one day and she's like, yeah, I want to lend on that deal. Well, I go through the inspection process and maybe some renegotiation of the contract or whatever it may be. And I say, hey, Kathy, I'm ready to close. And Kathy says, oh, well, you know what? Something came up and those funds aren't available anymore. So there's really, when it comes to private lending, it's literally take a blank sheet of paper, make it up as we go, which is a positive. But again, like I said, it can be very undependable, and it can be a negative if you find a person who's never done it before, they're not familiar with it. There are also some other risks. You know, if you don't do the paperwork properly, they may not file the lien correctly. You know, the title companies are not going to be very familiar with some of the way private lenders do it. But that's kind of the summary of private money. Again, I'm going to take questions. So if there's specific things you want to know about that, be happy to talk more about it. I have also been a private lender, and I still do private lending myself. So I have done all three of these that I'm going to talk about. So the second is hard money, again, which my company, Wildcat Lending, is a hard money lender. The advantages of hard money are that it's a pretty standard process. And most hard money lenders, not all, but most, can close pretty quickly. So for example, Wildcat, we can close in as little as 5 days. And that 5 days comes from when the investor gets us all the documentation. And when I say documentation, that typically we require a contract. Of course, we require an application, and we're going to require a rehab budget. And then if you're taking the title in an LLC, we're going to ask for your operating agreement and some other of those documents that you would need to prove that that LLC is a valid company. But really, the underwriting process compared to a traditional lender is really straightforward. It's going to be slightly more than a private lender, you know, assuming your private lender doesn't have, but again, your private lender may ask for more than a traditional lender. Who knows? Because it comes down to each individual offer. But again, back to hard money, the terms are generally pretty consistent. The downside to hard money is that the terms there is expensive. Typically, private money is expensive as well. And I always tell people, you know, I'm sitting here with a hard money lending company, but I always tell people that if you can get private money, that's probably going to be better than hard money. Most of the time it is. The challenge with getting private money is most of the time private lenders want to see a pretty good track record and some significant experience before they're willing to give you those loans. If you have a friend or a family member, sometimes maybe not. But if you're working with a fairly experienced private money lender, they're going to want to see some experience before they're just going to, you know, fund your deal. Hard money, again, you know, we're going to be consistent. Like I said, we're not going to run out of money, you know, unless something crazy happens. I will say there was actually several hard money lenders that went completely out of business through COVID, or they just completely changed their terms. That is very rare. But I will say the reason that happened was because most hard money lenders are going to sell those loans in the secondary market. So when the coronavirus hit, you know, crazy things started to happen economically in the market, those loans were now not able to be sold on the second market. All those buyers of those loans completely stopped buying. Therefore, the lenders had nowhere to sell their loans. Therefore, they stopped lending. That's one difference with what we do at Wildcat. We do not sell our loans on the secondary market. So we actually continued to lend we never stopped one bit through March and April when it was kind of getting pretty crazy. And we kept our terms completely the same. We never changed anything. So I'm actually very proud to say that, because there's not very many lenders that were able to withstand that, all the changes in the market there. We did just get a little more conservative on the decisions we were making on terms of which properties we were lending on, but our terms never changed, and we never stopped lending at all. You know, the last piece I would say about hard money that I consider a positive is once that relationship is established, the process gets easier and easier. So, you know, I am going to make the majority of decisions in Ohio. So if any of you come to Wildcat for a loan, it may seem like this big company, but I'm really making that decision along with, you know, there's a couple of other people, and of course we're going to talk about it. We're going to we get what's called a BPO. Anyone familiar with what a BPO is? It's a broker priced opinion. So essentially that's the same thing as an appraisal, except it's done by a licensed agent versus a licensed appraiser. So, and that was, Wildcat has never done BPOs until they came to Ohio, and I instituted that BPO instead of an appraisal because this is just my opinion, but I don't think appraisers know the market much better than a really, really good qualified agent who is doing a lot of deals in the market. And the advantage, significant advantage over a BPO is we can turn those around in 48 hours typically, whereas an appraisal is going to take 2 weeks, especially in this market with all the refinances going on. We may be 3-4 weeks for an appraisal to get turned around. The other major advantage of a BPO over an appraisal is the cost. So we do BPOs for $150, sometimes $200 max. An appraisal is going to cost $400. So half the cost to the borrower. We do not make any money on that. We pass that cost strictly right along to the borrower, and we don't make one penny. So if we save $200 because we're doing a BPO, then the borrower saves $200. Okay. Am I talking too fast? Am I doing okay?
Great.
Okay,
Great.
good. Just want to check in. So the last piece are the traditional lenders. So traditional lenders, probably everybody is familiar with traditional lenders. If you own your own house, you've gone through a traditional lender. This is by far, most people have more experience with the traditional lender than either private money or hard money. So the advantages of a traditional lender, hands down, you're going to get the best rate, you're going to get the best terms. It's not even close. The challenge when you're new to real estate investing, especially, is getting those loans approved through a qualified lender or a traditional lender. When I say traditional, I'm talking about the Chase banks, the Huntingtons. You know, your small community banks are still considered what I would call traditional lenders. And I would urge you, go to those small community banks. Do not go to a Chase. Do not go to even a Huntington, which they're bigger than, you know, your small community bank. But Huntington's going to be better than Chase. But I urge you, you're going to go through a ton of hassle and it's going to take forever. And then who knows if you're ever going to end up getting it done if you go to one of those big banks. So 100% stay away from those if you can. I'm trying to think of the small, like Park National. I work with Park National Bank quite a bit. They're a great local lender on the traditional side. First Financial Bank they're getting a little big. I would actually urge you to probably stay away from them. They used to be good, but they've gobbled up a bunch of smaller banks, and now they're getting, you know, more along the lines of Huntington and some of those other bigger banks. But again, back to the advantages, you know, they're just going to have, I mean, the rates right now are 3, 4, you know, even on the investment side, maybe you're 5%, which is half of what a private money or hard money lender are typically going to be. So significantly better terms. The downside is they're not going to offer rehab funds most of the time, where hard money and private lenders will. We will fund your purchase price plus your rehab funds. Whereas again, traditional lenders will hardly ever do that. Major downside, which I already kind of hit on, of a traditional lender is the process is just very slow. And in a really, really competitive market like Columbus, you know, I think everybody, if you're out there looking at deals, you know that anything good is going extremely quickly. And if you're coming with a pre-approval letter from a traditional lender, good luck, because you're probably going to lose to a cash buyer or someone with hard money almost every time. So with that, that's kind of my quick overview. Be happy to answer any questions that you guys have.
Okay, I'm going to start off. I have a question. If I wanted to come to you for, say, private money, what documentation would you need to have from me?
So I also, in full disclosure, I borrow private money myself. I don't use hard money. And that's because, you know, I've been doing this for 10 years and I'm able to get private money, which again, my terms are better. My process is a little bit easier on the private side. So Kathy, to answer your question, the documents that we provide to our lenders on the private side. So we always do a rehab, a budget, and I think anybody's going to ask for that. So I would encourage everyone, when you want to send your deal package to any lender, especially, you know, hard money and traditional banks are always it's going to be mandatory, but most private lenders are always going to ask for a rehab budget. And I just put that in Excel. It's not down to the penny, but it's a good ballpark of the total cost of what we think it's going to be. And we itemize it down to, you know, what's our cabinet cost? What's our flooring costs? You know, what are we going to put in landscaping? trash out. You know, that's one thing I find that people forget about a lot is what does it cost to rent those dumpsters and go have all the trash that, you know, sometimes you buy a property from someone who leaves the whole house full. If they inherited it through probate or they were just, you know, hey, look, we buy properties from hoarders and you got 3 dumpsters. I mean, that's $2,000-$3,000. That could be a significant part of the budget. So rehab budget, we're going to put a note and a mortgage to secure that loan. And then the last piece is we're going to provide comps to support the value. And that's really it on the private side.
I think that's important. As a matter of fact, in our mastermind group, we were just talking about having a chart, if you will, that just gives some averages for Central Ohio on what some of those costs are. And it's a great way to put that together, especially if you need to know what the numbers are so that you can get your financing. So does anyone else have any questions? Everyone is on mute, so please unmute yourself in the upper right corner of your picture. And I see that Ryan has a question. Ryan, go ahead.
Brooks.
Hey Ryan, how you doing?
Doing very well. I'm glad you're here. It's good to hear some information about lending. I was actually just working on something earlier today with a flip that I'm looking at, and I'm a little bit not confused, but I'm struggling with it because I can't find good data for comps. And, you know, the seller seems to think that the price is way higher than what I can find data for. And not only that, I'm really concerned about the market going forward. Right now, I think a lot of people, you know, right now you're looking at a lot of houses going into forbearance this month. And next month, what is that going to mean? That's going to mean a lot of more houses in foreclosure. And subsequently, what does that mean? That means the market is going to go down and these houses are going to drop in value. Is that something that you're seeing, and how does that affect the way that you're looking at deals coming in the door?
So I think you're being smart. I think everything you just mentioned, I would 100% agree with. You know, we always plan for the worst. And when I look at a deal that I'm evaluating, you know, let's say I'm looking at a deal from a borrower with Wildcat. I mean, really the way we look at that is, do we want to own this property, right? If the borrower defaults, and that's the mentality that we have to have. So if you're bringing us a property, do you mind telling me, like, not the address, but just what part of town? Is it in a neighborhood? It sounds like if you're having trouble comping it, could it be rural maybe?
It's sort of rural. I don't know if you're familiar with South Bloomfield.
I definitely have heard of that area, but I can't put a finger exactly where it is.
If you take 23 south, just, you know, maybe 10 minutes south of Columbus, there's a small little town there. And, you know, there's areas there that are newly developed where, you know, there's probably between $250,000 and $350,000 houses, you know, in this one neighborhood. But this house is not in that neighborhood. It's in a neighborhood, you know, right next to it. It's actually the village of South Bloomfield. And these houses are older. You know, they're just not comparable to the houses in the new neighborhood. But, you know, this guy who's an investor from out of state is looking at it like, hey, look, I'm looking at a map and these houses are worth this much and this house is worth this much, and they're only 5 minutes apart.
Yeah.
But so I know from boots on the ground they're not comparable. They're not the same house.
Right. And I could not agree with you more. So I would tell you, I'm going to do the same thing. I mean, when I go get my BPO, the person who does that BPO, they're going to do the same thing, and they're not going to use those comps from that new neighborhood. So, I think you're making a very smart decision, and I would just tell you that you got to stand your ground. And if you can come to agreement, great. And if you can't, you got to go on to the next deal because, sorry, 1 second. Let me, my kids are making noise. 1 second.
Glad it's yours and not mine.
Okay. Sorry about that. If you want, you know, feel free to email me that. I'd be happy to take a look at it. By the way, guys, I think I might've said this, but I'm also a licensed agent. So I have access to the MLS and, you know, all that stuff. So I'd be happy to look at it, give you my opinion of value, if that would help. But I think So as it relates to the bigger picture of your question in terms of the market, we can never predict what the market's going to do, but you're exactly right. I mean, we'll see what the government ends up doing with any more government assistance. I think they're going to have to do something. But what we've seen in the market, like I said, we got a little more conservative in March and April on our underwriting, not only at Wildcat, but also the stuff I'm buying as an investor. But it's been absolutely incredible. I have never seen houses sell as quickly and as well as they have. I mean, since COVID, it's actually improved the market, I feel like. And I think flippers have a distinct advantage in this environment versus homeowners who are living in their house. And the reason for that is they're vacant. So March and April, again, I keep going back to that because I feel like that was like the height of the paranoia, I guess is the word I'm looking for. And when you're listing a vacant house, when people don't, people can go right in and look at your house. So inventory is already constrained. I'm not sure if anyone's seen the data, but inventory is literally historically at its lowest number ever when they released the Central Ohio Housing Report from the Board of Realtors last month. There's never been less inventory on the market. And when you're selling a vacant property that you're flipping, you're even at more of an advantage because people can go in there. They're not worried about people being home. Of course, we're all going to wear masks and do the right thing as far as, trying to be careful and you follow those guidelines, but it's a good time to flip a house. I can tell you that much.
Thank you.
Anyone else?
Any other questions?
Yeah. Can you hear me, Brooks?
Yeah. Yep. I can hear you. Hey, Will.
It's Will. So, so you touched on a couple of things. And one kind of stood out with me in regard to the multiple ways of financing. And I guess my question is, are we noticing a trend? Because I know I have quite a few friends that invest, and I know there are some that have cash, and I know cash is king in the world we live in. So as opposed to having your conventional 20-25% down, getting financed, is that kind of the legacy stale way of purchasing now, is to getting a traditional loan? Is it best to have the cash, or is it a common medium in between? Because I feel like there's a trend occurring right now, and I don't want to be lost in the sauce. So I'm trying to figure out, how do I align with the trend that's happening right now?
Yeah. So to answer your question, I mean, just put yourself in the shoes of a seller. So if you are a seller, cash is always going to be great. I mean, you always would rather have a cash offer versus a financing offer where you have that financing contingency. Again, with the values the way they are in this market, especially with a cash offer, you're not dependent upon an appraisal from that lender for the deal to be approved. So that's a major advantage. Not only, there's a couple advantages. One is typically cash is going to close quicker, so the seller gets their money, which in the end, that's all a seller wants. They want their money and they want to be able to move on with their life. So I'm assuming probably your next question is, well, how do you get cash, right? If you don't have cash, you don't have it. And can be a challenge. And I've been there. So my advice to people is always, before you call a hard money lender, before you even call a private lender, if you own your own home, and I know not everybody does, but if you own your own home, from accessibility of cash, the first thing you should do is go get a home equity line of credit. Okay. If you have access to that, that is the number one thing. You should all go to your bank tomorrow, do whatever you can to get a home equity line. I can tell you, as long as you, again, own your own home and you have equity in your home, which again, with the rising values in this market, maybe you didn't buy it with equity, but I can tell you, maybe you do now. It's worth checking. And most of these banks will do home equity lines for no closing costs. The rates are incredibly low. I'm talking like 3.5, maybe 4% on the high end, which is still incredibly low. So first thing, go get a home equity line. If you don't have access to a home equity line, then the second best thing to do is go to a hard money lender or a private lender. And, people always want proof, and we will provide proof of funds. If you go to our website, fill out an application, we will, as long as you're qualified, obviously, we will provide you a proof of funds. And the next question people always ask is, can I write a cash offer with your proof of funds? I would tell you that is up to your agent. I cannot give you that advice. Technically, if you want to get really technical, hard money is not cash because it is dependent upon that BPO. It's a whole lot closer to cash than a traditional loan, that's for sure. Private money, I would say 100% you should write a cash offer. So that's another advantage to private money over hard money. But there's many people out there, I can assure you, that write a cash offer with hard money. And so, if you can write the offer, get it accepted, and then you provide that proof of funds a couple days later, hey, you got the deal in contract. So if it works, it works. Does that help?
Yes, it does. Thank you.
No problem.
Okay, any other questions for Brooks?
I do, Kathy. I have a question for you, Brooks. Hi there.
Hi, Stephanie.
I'm Stephanie Jenkins. I'm a licensed real estate agent. I'm not a lender. I work with so many lenders. You're totally speaking my language. I'm on the same page with every single thing that's come out of your mouth tonight. So thank you. And I have plenty of investors that I work with I do have investors in the last 60 days that have gotten private money from a family member. So easy. It's been amazing, extraordinary. Others who are scared to death of what we would say wildcat, a hard money lender, just scared like, oh my gosh, I don't know if I want to pay those rates. With rates being so psychotically historically low, and we know that they are, and you mentioned it is more expensive, but it's not so far above the bar. Can you actually tell the group, and so many people are going to be watching this as a recorded segment as well, can you tell the group a little bit about your hard money requirements, if you will, maybe time on the same line of work, if that does count, credit score, if that does count, percentage rate? I'm not saying to the T, but like a general overview of what you require.
Yeah, absolutely. Thank you. It's a good question. So I should have put my website. I'm going to put that on here now. All of this information is on the website. In summary, so we are going to be 3 points, sometimes 2. If you have some experience, we develop a good relationship. We will negotiate on the points a little bit. Also, we'd negotiate on the points if we really like the deal. If you're in a really good, stabilized neighborhood, we will talk about the points a little bit. The rate, unfortunately, we do not negotiate on. Our rate is 12%. So, like I said, I'm the first one to tell you it's expensive. I typically pay on my private money that I borrow personally, we pay 12%. So the rate is pretty common, pretty standard. The difference in what I pay my private lender versus what Wildcat charges, I don't pay any points. So that's, it's a significant difference. But back to what our requirements are, we're going to look at 2 factors the most, and it's not credit score. Okay, so we don't look at your income. We don't ask for a W-2. We do no income verification whatsoever. We are going to look at the quality of the property or the asset first and foremost. Second, we're going to look at the liquidity that the borrower has. So for simple math, let's say it's a $100,000 loan, and we're going to require those 3 points. So we want to see your bank statements. We're going to ask for 2 months of bank statements showing that you have liquid funds in the amount for your down payment. So, and we typically fund up to 90% of your cost. All right. So let's say, again, $100,000, let's say it's a $100,000 purchase. Sorry, I said $100,000 loan. $100,000 purchase would be a $90,000 loan. Again, you're going to bring 10%. So you'd need $10,000 plus 6 months worth of payments. 6 months of payments on a $100,000 loan is going to be $6,000. So in that particular scenario, we want to see $16,000 in the bank, and then there's going to be some other fees at closing. So it's really going to be closer to 20. So we want to see liquidity, quality asset, and then credit score is third. So, we like to see credit scores above 600. That doesn't mean we won't do a deal if a borrower has lower than 600. We may just alter the terms slightly. And we may ask for those 6 months of payments in escrow if the person has really bad credit, if they have a bankruptcy or just something, that's outside the box. But again, it really comes back to the property. If we really like the property, then we're going to get creative and try to get a deal done. Is that what you were looking for?
Yeah, that's great information. And I know that you're on a little bit of a time constraint, and it's so informative what you're saying. And I think to follow it through even just a little further, if I could add to the question, how do you hold the property as an asset? That can you explain to the group what it means for you if you don't get repaid, and how you handle the situation of the asset ownership, whether it's in between or at the end, or what your terms are in terms of length?
Right. So it's another good question. Thank you. You're leading me down a very good path. I appreciate that.
It's so important. People want to know this.
Well, it brings me to, and I should say this up front, but the reason, I keep saying hard money is expensive. Private money is expensive. It is. The reason it's expensive is we have to charge a premium because we're taking a risk on that borrower. So again, we're not verifying that you have the income that you say you do. We're not going through a very significant underwriting process where we look at your tax returns and we look at, we're essentially almost taking your word for it. I mean, we're going to pull your credit, but aside from that, it's like, show us your bank statements. I mean, you could have just told a family member to throw 30 grand in the bank and then sent us a statement and then pulled it right back out for all we know. So that's why the rate is more expensive. Also, we borrow our funds. So we have to borrow our funds and then lend it out to the investor. So when we have a 12% interest rate, we're not making 12%. We're borrowing it at whatever, 4 or 5. We sometimes raise money from private investors as well, and we're paying 7, 8% on that. So we have to make money, or we wouldn't obviously be in business. So that is why our rate's a little bit higher, but it mostly comes down to risk. And then to your point about how do we secure the property, if the borrower doesn't pay that back, we're not going to come after your personal residence. We're not going to take your car. We're not going to do any of that. We're going to take the house back that we lend upon. And so we have to go through the foreclosure process for that. We have to do the rehab that wasn't completed, all those things. And then we have to get it back to the market to sell. So all those things come back to the risk that we're taking on. It's a much higher risk loan. So the higher the risk, the higher the return. It's as simple as that. So
what length of term do you typically see? Do you give typically 12 months max on your rehabs?
So our initial term is 6 months. And then it's going to automatic. If you haven't paid it back in 6 months, it will automatically extend to 9 months. And then if you haven't paid it back in 9, we're just going to have to sit down and figure out what's going on. We're going to visit the property. We're probably going to say, hey, meet me at the property. A lot of times if someone hasn't paid it back in 9, they're not going to meet us at the property. They are going to avoid our calls and not show up and, things like that. But we will work with people, if it's a reasonable borrower, something like COVID happened and we understand there were some delays. The city wasn't doing inspections, obviously, for a couple of months. That's a very understandable situation. And we will work with people on that, and we will extend it to 12 months if we understand the situation and we think that borrower is doing everything they can to get that project done and get our loan paid off.
Got it. Thank you so much. Guys, group, I really encourage you to reach out to Brooks with specific questions, or ask them now while you have them, because it's a wealth of information. I hear every day the questions that I'm asking you, and people are straight afraid to even call you. And so they think they can't get approved. And what you just explained is the fair opposite.
Right. Okay. Well, thank you so much, Kathy. I'm going to jump off. Everyone, it was very nice to meet all you guys virtually. Thank you very much for your time. And like I said, reach out to me if there's anything I can do to help you. Okay.
Okay, and before Brooks goes, I just want everyone to know, if you click on the chat box at the bottom and open up the chat box, it will give his phone number, his email, and his website. You can get all of his information right there in the chat box. And Brooks, thank you so much. I know you got to jump off. I know you have another commitment. Again, thank you for your time tonight.
Okay, thank you. Have a great night, guys. Bye-bye.
Bye-bye. Okay, with that, we're going to move on to Stephanie. And I'm going to give you just a little training on a Zoom call. If you folks are on a laptop or a desktop or a tablet where you have a space bar, you can leave your camera the way it is. Your mute button, however, you can leave it alone and just press the space bar, and that unmutes you. You just hold the space bar down and talk, and when you let go of the space bar, you're muted again. And so that's an easy way to unmute yourself when you have something to say without trying to get your mouse around there or whatever and click your mute on and off. So that's just a little side lesson on how the microphone works. So Stephanie, I want to turn to you, but I want you to give us just a brief background. We have some new folks on that have not met you before. So give us just a brief background of yourself before you present. And one of the things you and I talked about was how important that appraisal is. And of course, that's right up the same topic that Ryan was talking about on his deal, is trying to find out those comps. And once he gets some comps, how likely is it that the appraisal is going to come in that support those comps? So with that, I'm going to turn it over to Stephanie.
Great. Yeah, absolutely, Kathy. I'm so pleased with the things that Brooke said, and I'm going to recap and follow up a little bit. And a little bit about me. I am a licensed real estate agent in Ohio. I'm from Ohio, originally from Hilliard, and then I reside now, and I have an office in Canal Winchester in the Village, and also I have an office in Gahanna and New Albany. And I work with residential real estate. I also work with investors. I do some commercial real estate, quite a bit the last few years, actually. And my sister is a realtor. My dad was in real estate, and I started my career actually in 2001. If anyone wants to jot down the name, one of the most famous agents in our country, Alan Shafran, at alanshafran.com, just like it sounds. I was his listing manager, and I learned everything to begin with from Alan Shafran on the shores of the Pacific Ocean in San Diego County in Carlsbad. And for Remax, actually, in 2001. And I was Alan's listing manager. When I made my way back, I learned everything you could learn ground up. And I made my way back to Ohio and went to work for builders in Greater Columbus, like Romanelli and Hughes and Long and Wilcox. So building ground up custom condos, custom homes, Epcon, resale, like condos and homes that are midline as well. And then in 2009, at the end of 2009, I got my license and I joined Remax myself. I actually first went to work with Mitch Domensky, who we had on last month. Was it just last month? He's amazing. Mitch was my broker. I learned so much from him. He is an investment guru. If anyone doesn't know Mitch Domensky, keep that name in your pocket. He's a great contributor to our group. And then now I do, as a licensed agent, over the years, I've also owned, flipped, and rented out over a dozen properties on my own. And at that age, at my age now, I mean, that's decent. Maybe a decent number for where I'm at with where I'm at right now. So I represent resale investors, work with a ton of lenders, and that's my background. And I'm here for all of you. If you email me, I really prefer email. My email, I'm sure Kathy will give out to the group. It's Stephanie Jenkins at remax.net. And I'm here for all your questions. And I really want to give a quick recap on what Brooks was saying on the market itself. Guys, this is huge for investors, and I'm going to hit on all the open areas that he did, but I'm going to go into a little bit more detail pertinent to right this minute. When the Columbus Board of Realtors, the Ohio Division of Real Estate, released the numbers, and by the way, if you Google Columbus Board of Realtors, Ohio Division of Real Estate, you can get to all the statistics for how fast. These are by community, by school district, by zip code. You can run numbers on how fast the properties are moving in what areas of Columbus. And you can run this a million different ways. The pie charts and the graphs that come out are so helpful to any investor that says, where do I start? The inventory was already record setting this year, guys. It was already record setting last year. For all of you that don't know, and this speaks to funding your real estate a lot. It's what bank is going to give you money and how is the market based on where the market is at. So 6 months is what any lender who's going to give you money is going to look at where we're at in the market. And 6 months of inventory is a stable market all across the nation. And lenders are going to have interest rates that are right there, sub-range interest rates, anywhere from 3% to 4.5%, very normal. And by 6 months, that means if we stop putting houses on the market today, guys, that means we would run out of houses for sale in 6 months. What Brooks was discussing was the inventory being so low, and it's so hard for investors because you have to fund buying these investment properties, and cash oftentimes wins out. That's because before COVID, we set another record at 2.8, which means, buddy, it is a seller's market. There is not a lot of inventory. Sellers can name their price. That was right before COVID. That was in February. I just would be the first one to let you guys all know it went down to 2.6, 2.451. It went all the way down to 1.8, record setting, unbelievable. That was at the beginning of COVID. And I just want to point out that right now, last week, we're down to 1.1 month of inventory on the market in Greater Columbus. It's unheard of, people. It's unbelievable. It means if we stop putting houses on the market today, they're going to sell out in 1.1 months. There will be no more properties for you to buy. So for you as investors, the flip side is cash really, really, really is king. And I can't stress that enough. And I work with investors that are actually from Kathy's group that are in the price range, no joke, in the price range of $19,000 purchase for a whole house. We're talking a 2 or 3 bedroom house all the way up to a $200,000 3-bedroom house in Arlington that needs flipped and is going to sell for $400,000. So no matter what the scenario, you want to get cash to fund your property. And I'm going to talk about lending just like Brooks did, but I'm going to talk about when you get your cash. So the most popular way to get cash is you either have credit and the job and you go to what Brooks was saying. He is a private lender and he's also a hard money lender. So to recap on that, you heard him say his criteria. When you make an offer on any property as an investor, chances are in this market being down to 1.1 month of inventory, guys, I'll give you a few pros and cons. Number one, if you don't have cash to buy, it's tough, but hard money is cash. Remember how Brooks said, man, I don't know if you can write an offer with hard money as cash. It is. He can close in 5 days on a hard money loan after he has everything he needs, meaning your credit score is 1/3 of it, your bank account is 1/3 of it, and your cash on hand and the property itself, the property he looks at, where it's at and what's going on. There's probably going to be between 10 and 20 offers, if not more. I've seen 30-something offers on investment properties that are in the Columbus MLS, and cash is going to be the way that you finance it. The way that you're going to get your cash is going to be multiple ways. I can name 10 right now. So in terms of a client who's on Kathy's team right now with Masterminds, getting money from a family member, yes, that's private money. Wow, they trust me. I can get the money from the family member and they're going to let me have it for 24 months and they're going to hope for the best that I flip this house. That's private terms. And then when you go to somebody like Brooks, and Kathy and I know other hard money lenders as well, then you're looking at hard money being at that 12% rate. I want everybody here to know that 12% is standard across the board when you are going and asking for hard money. And I want you to know this too. The turnaround times of the terms for hard money lenders, guys, it's going to be 90 days. Can you get in there full time and flip that property and be done with it and get it on the market and sell it? And the question is, can you do it in 90 days or less? That's the first level of a tier for a hard money lender. The second level is going to be 6 months. And then like Brooks said, 9 months. That time that you pay back the money in with the 12% interest rate, he mentioned points. For any of you that don't know what a point is, I want to explain that because that's a lot of money out of your pocket up front. When you get the money from a hard money lender to pay cash for a property, which you've got to have cash to buy an investment property right now, I would give that a weight of about 70%. But you can buy property with a loan from a bank, a portfolio loan, a conventional loan. You could definitely buy property with a loan. It's the problem is, folks, is that you're going to get beat out by cash. That's why you want to have cash, especially in those lower numbers like 20,000, 30,000, 40,000. So let's use the round number of 100,000, which by the way, guys, that's quite expensive for an investment property. 100,000 is a lot of money. You might buy something instead for 50,000 and sell it, buy it for 50, put 50 into it, sell it for 150. That's like a super more reasonable thought process. So if we use the value of $100,000, 1 point is 1% of that price. So it's $1,000. So when you go to get money from Brooks and say, geez, I want to get hard money loan, I'm willing to pay the 12%, and the property I'm buying is $100,000. Remember, Brooks said he charges anywhere from 2 points to 4 points, depending on the profitability of the project that he's looking at. Also, a little bit of weight goes into your credit score, etc. So what you're going to have to do is, not only did Brooks say he will loan you 90%, so you're going to have to come up with $10,000 on your own. He also said he wants 6 months of cash in your account that he can see to pay the 6 months of payments, to pay the payment. And then also the points. So if he's charging you 2 points, that's $2,000. $4,000 is 4 points on a $100,000 loan, the cash he's giving you to close on the property. You can write cash offers with your real estate agent on a hard money or a personal family loan. You can definitely write a cash offer. You write the closing date for the same day you're getting the money from somebody like Brooks or another hard money lender. So with private money and hard money, that's how you're going to get cash. But there are other ways that you can buy your first properties, and other ways you can do it as well, with loans as well. So the next one that I want to go to right off the board, right after the hard money and the private money, those two, I want to go to portfolio loans. And this is where you go to a small bank in your community, or a private bank or a credit union, and you present your case. It's one step past private money and hard money, a portfolio loan. And you say, I'm Mr. Smith, and I would like to buy this home, and I'd like to rehab it. And this is what I've got for you. And this is what the homes are selling for. This is called a rehabilitation portfolio loan. So a rehabilitation portfolio loan is exactly what you're going to ask for when you go to a small bank. And like Brooke said, stay away from the Chases and the Fifth Thirds. And Huntington is known as a large commercial bank for investors, but they're the only one that's somewhat decent. Stay away from all your major banks. So when you ask
Stephanie, I'm going to jump in and ask a question.
Yeah.
My question is how can you tell, if you're not familiar with all the different banks, how can you tell one's a small bank or one's a big? I mean, we know that the Chases are big, but when I start looking at names of banks, how do I know who to contact?
Absolutely. That is a great question. The answer is, it's truly marketing. If you've heard of the bank, if these banks, wherever you guys live in your town, there's going to be a Burger King, a Panera Bread, a Chipotle, a Walmart, wherever you live. And within that same area, there's going to be a PNC, there's going to be a Chase, there's going to be a Fifth Third, there's going to be a Huntington. There are going to be the big, we call them like the Big 10 banks that you've heard of. Now, you know that you can approach a bank for a portfolio loan if they are a credit union. Credit unions give portfolio loans. Credit unions do not typically, for a portfolio loan, guys, let me give you the definition of a portfolio loan, because you may not know. A portfolio loan, when you go as a person and you buy your first home, and a lot of you have heard of a conventional loan or an FHA loan, and we can go into those types of loans because Kathy and I actually bought our first properties ever with FHA loans. Both of us did, and we turned those into investment properties. Then we made money off of them. So I'm going to go back to that. When you buy like a conventional loan or an FHA loan, you buy your first property, you're going to live in it with your family. Those homes are sold on the secondary market. So it's a whole stringent set of criteria. You have to meet this crazy stringent set of criteria. You have to have 2 years in the same line of work on a job. You have to have 2 years tax returns. You have your credit score has to be, it was, guys, 580 before COVID. It's 680 now. It's 680 to buy just a regular FHA home right now. The definition of a portfolio loan is that this loan is not sold to anybody else. The place you approach to get a portfolio loan, and I will tell you, more than 50% of banks do portfolio loans. Credit unions do them, Third Federal, First Federal, Brooks talked a little bit about First and Third as well. The banks that are in your community, when you see something like Kemba, for example, Telhio Credit Union, these are huge banks for portfolio. They're very user friendly. And what it means is there's a group that meet once a week. You turn in your loan application for a portfolio loan. You call somebody on the phone and you say, well, geez, you know, I want to do a portfolio loan, or do you do them? And they say yes. And you say what you're looking for. There's a group, no joke, guys, that meet once a week at every portfolio bank. There's a group of about 5 to 7 people that open up your folder and they look at who you are and your history, and they decide amongst the group of people whether or not they feel like you're worthy for them to give you the money out of their own building, and they don't sell the loan to anybody else. So if you need cash to buy a home and you go through opening up a portfolio loan, or as Kathy has done, a portfolio line of credit, that's amazing to have a portfolio line of credit, because you can tap into that and you can get cash when you need it. So when that $19,000 property goes on the market and you know you can rehab it and sell it for $90,000 or $100,000, for example, Kathy just got a significant portfolio line of credit at her local bank. Guys, it's massive and it's impressive.
With a phone call. I got it with a phone call.
Yeah, please.
I got my line of credit with just a phone call. He didn't even ask for any paperwork, because it's a bank that I work with all the time. And I just called him up and said, I want 50,000. And he said, when do you want to open the account?
It's amazing. It's extraordinary, guys. So that's the third leg of funding your project, is to either have a project in mind or not and do a portfolio loan. Now, the terms on portfolio loans, just so you're aware, they're going to be about a percentage point to 2 percentage points higher than par. So right now, the par interest rate, which is mind-boggling, is 2.25. That's what you're going to get to go get an FHA loan today or a VA loan today. So you would add about 1.5 to 2 points, 1 on the low side, 2 on the high side. And the terms for a portfolio loan, guys, they're going to be 20 years or less. So you're going to have that loan 20 years or less. Obviously, if you get a portfolio loan and you buy a property, you have no prepayment penalty on a portfolio loan, because these banks want their money back really, really quick. So if you do flip a property, or if you buy and hold a property and you get enough rent, then you can pay that loan off within whatever period of time. So portfolio loan is the third way, or a portfolio line of credit. And then we're going to go into, well, what about just a straight loan for me to buy a property and flip it or rehab it? That's where, this is what Brooks is called. He's called a mortgage broker. A lender is somebody that works for a lender. For example, they work for Chase. They're a Chase lender. They're the person in the chair that lends mortgages for Chase. A mortgage broker is what Brooks is. He's also a licensed agent, but when he wears his mortgage broker hat, he has his own brokerage license, a high-level license, and he has the right to make decisions on lending that are not sold on the secondary market. And his underwriters for a mortgage broker, guys, they're typically in-house. And the word underwriting is really important, because it's the underwriter. And in the case of Brooks, his company is called Wildcat. He is the underwriter. You heard him say he makes his own decisions on whether or not he gives money for his hard money loans. So moving back to a portfolio loan, it is the group of 7 people who actually, 5 to 7 people who sit at a table. They meet once a week. They're with your credit unions, they're with your small banks, and they offer unique loans tailored to who you are as a human being. So if you've gotten turned down for some great big conventional loan, think about going to a portfolio lender who look at you as a human and not as a number. And then on those portfolio loans, a group meets about once a week. They give you the money for about 2% higher interest rate than what you would pay at a big bank. And then you have about a 20-year or less term to repay that. So when I move past that, I can't help but have to say, you can completely go to a Huntington or to any bank, like the bank that you bank with right now, Most banks are going to completely, if you say, well, geez, I'm a real estate investor and I have an LLC or I don't have an LLC, it doesn't matter if you have an LLC or if you don't. If you want to buy property as an investor and you want a commercial loan, there's two ways to do this. If you're an LLC and for some reason your accountant and your attorney has made it clear to you that you want to fund all of your properties with an LLC, I want you all to know that what you're getting is you're actually getting every time a conventional loan. You have to get a commercial loan is basically what I meant to say. It is conventional, but it's commercial. So if for all of you that have an LLC and you go to any bank at all, this is a conventional product and it is going to be sold on the secondary market. Because remember, we moved a step up from portfolios. Portfolio loans are held in-house at the bank. So when you say, okay, well, I do have an LLC and I do want to fund it and I would just like to apply for a typical old loan, you can do that. And that is a commercial loan. And within that commercial loan, there's still that subcategory. Don't forget about your subcategory, which is a rehabilitation commercial loan, which takes you again to getting the money as a company owner. Keep in mind, we haven't yet gotten to getting a loan in your own name as if you're going to live there for the first 12 months, because guys, that's an option for you. You can do that. So you're still on the commercial level. You've got your LLC. You want it to be in a business name or an LLC. You're getting a commercial loan. It goes through all the channels of underwriting, including appraisal, which I'm going to talk about appraisal in the grand scheme of life. I'll do that. And then finally, I want everyone to know here that Kathy and I got our first homes that we actually ended up having as investment properties. We actually got those loans with typical loans where you go to any bank or mortgage broker and you get an FHA loan. And an FHA loan is an owner-occupant loan. And I know that you're like, well, but I don't plan on owner-occupying it. Well, guess what, guys? I have something to tell all of you. Maybe you don't have the cash and maybe you don't have the equity in your own home right now to pull the equity out to get the cash. And maybe, just maybe, you have a conventional loan on your property and maybe you're in the position where you can't get any other type of funding. So the lowest level credit score to get an FHA loan or a rural development, a USDA loan, you can actually, or a VA loan if you're a veteran, is 12 months. If you have to do it, people, get a VA loan or an FHA loan, and that is in your name, and you are paying it back over 30 years. And guess what the interest rate is today? It's 2.25. It's insane. But with an FHA loan or a VA loan, a veteran loan, you are saying that you are going to owner occupy the property for 12 months. That's not completely out in left field, because you could move into that property on a part-time to a moderate to full-time basis. You could occupy that property. You can get it at 30 years. You can get a low interest rate at 2.25. You can go through all the channels of getting that for about a 620 to 640 credit score right now. It did go right up to 680 at the beginning of COVID, but it's adjusted a little bit back to normal now. You are going to have to sign paperwork saying that, in fact, you do plan to live in the property, and it does have to be in good enough condition to be appraised for an FHA loan. So if you say, well, I'm going to live there, I want this low cost loan, there is going to be an appraisal, but I have to just, I hope I'm not going a little too fast, and I'm willing to put all of this in writing with a pie chart that and graphs that bring it all down, a flow chart, if you will, a flow chart making a segue for all the loans I'm talking about. Because you can buy an owner-occupant property. If you don't have an FHA loan right now, you're entitled to one FHA loan. So you get that loan. You can only have one at a time. You say you're going to live there part-time to full-time. You sign a document saying that you are, and you get in there and you can rehab the daylights out of it, make it much better. Remember, it has to be nice enough to get an FHA loan. You know, the stairwells have to be in good working order. There can't be crumbling concrete. There can't be old crumbling paint. But you can also get, this is huge, you can get an FHA rehabilitation loan. That way you get money to fix the property and you actually are stating that you are going to use the money to fix the property and you are going to live in it, and the retention, guys, is anywhere at the minimum from 12 months to the maximum of 5 years is the retention. So you can certainly sell the property before then. There's nothing against that. There's a few lenders left that still have prepayment penalties. In terms of the rehabilitation loans and the ones that are owner occupant, it's the least money out of your pocket. It's the lowest credit score that you have to have, and it's the lowest interest rate. That's huge, because if you do get an owner occupied rehabilitation loan or a non-rehabilitation loan, you can go to any bank that you want, but you still want to stay away from the big banks. So go to your credit union, go to a mortgage broker. Brooks can also do typical FHA loans as well, because he's a licensed mortgage lender. And you buy the property with that. Now here's the kicker. The question becomes, are you going to be able to buy property in this market? And what happens with the appraisal, which Kathy mentioned? So in this market, almost every property is being eaten up quickly within 1 to 2 to 3 days on the market. There's a dozen offers on it, but that's just the way that it is. And I have to speak to what one of our members said earlier. What do I think about the market? And is it going to crash? And is there a bubble? And what's going to happen to financing? Well, with financing, which is what we're talking about today, we already saw the credit score right when COVID hit go from 580 to get approved for a loan all the way up to 680. But you did hear Brooks say that he'll consider people in the 600s and the 500s, but you're paying 12% interest and you're paying points, and you're expected to flip that property. You're expected to rehab it for the hard money and to sell it and to pay back Brooks. If you go this final route, which is what Kathy and I did with our first properties, we bought them with owner-occupied FHA loans at very low interest rates. We lived there for a period of the time, and guess what we did? We both fixed them up, and we both moved out and we rented them, and we both filed them with Franklin County that they're now rented out, which you do need to do because you're not living there, you're renting it out. Or you make it really, really nice and you flip it and you sell it for a profit. And you have to build each time you sell. The whole goal as an investor, the whole goal is that you're getting money to fund your retirement, to fund your income, and to fund your next flip. So that's the whole goal on selling these properties and making money, whether it's by holding them and renting them or flipping them. And that brings me to my really final point, and then I'll open it up if anyone has questions. It's appraisals. Guys, appraisals are all over the place. Now, there's a couple of different kinds of appraisals. If you get hard money or private money, then private money, a family member, they just trust you, so they trust you. But hard money, which is what Brooks talked about, he wants a BPO, which is a broker price opinion. I do broker price opinions all the time. It means I look at the neighborhood and the market and I tell Brooks, yeah, Chris can definitely, this property, if it's in great condition, is definitely worth $150,000. He only wants to borrow $60,000. Definitely it's worth it if he turns in his paperwork. I say it's got a BPO value of $150,000. So Brooks says, okay, thank you. And Brooks, by the way, guys, keep his number because he can do that too. He's a licensed agent. And then he gives you the money that you need in order to, that say you're rehabbing it, that speaks to rehabbing it, then you get the money that you need to flip the property. Now, when it comes to buying and holding, appraisals are all over the place. And like someone mentioned earlier, they want to buy and then fix a property up, and that's called doing and keeping it. That's called doing a cash out refi. That's a whole nother way that we haven't talked about to fund your money when you buy property and you want to get money out of the property. So let's look at it this way. You're buying for sake of dollars. You're buying $100,000 property. You know that the houses in the neighborhood are selling for $200,000 and $220,000. You know they are. You know this place is so dated. Oh my gosh, it's terribly dated. So you need $100,000 to buy it. No matter how you decide to get the money, which are all of the ways that we talked about, and I definitely want to answer specific questions. What it comes down to is somebody's going to have to give you at least $100,000, and there's two things that are going to happen. An appraisal is going to happen with every property that you get a loan for. An appraisal is going to happen. You pay for the appraisal out of your pocket. It's money that you have to spend, guys. Keep in mind, if you're going to get a loan any lender is going to say, give me your debit card number because you have to pay for the $400 or $500 appraisal right now. And you really do. So keep that in mind for your finances. You also have to pay for the appraisals too. So when the appraisal is done on the property that's $100,000 in this market, what we are seeing, if you all remember, the peak of the market, you may or may not, was 2005. The biggest bubble we ever had in the history was the peak of the market, 2005, summer of 05. Prices were where they were. We're 25% above that right now. And that is a fact. That is a financial fact that prices are 25% in this market in Greater Columbus above where they were in the peak of the market in 2005. So where does that leave you with an appraisal? Appraisals are all over the place. You want the property to appraise so that you can get your money. And this is unbelievable, but even people in Kathy's group, even in the last month, have bought investment property. I'm going to just use an example of one building that has 4 apartments in it. One of Kathy's members is in contract to buy this building that has 4 apartments. It's in excellent condition. It also happens to be in a really rural area, ironically enough. So these people happen to be in contract to buy it. They won the bid. There were multiple offers. They won the bid with the loan. They're getting a conventional commercial loan in their LLC, and they're buying it. And the appraisal came in $6,000 less than what they wanted the appraisal, what they offered to pay for the property. Let's just say that's right around $100,000. The appraisal came in $6,000 less. And so what happens when that happens is are you expected to come up with $6,000 out of your pocket? And the first answer is yes, you are. Or you negotiate it. You absolutely negotiate. You tell your realtor, well, we want you to fight the appraisal. We think it's worth more money. It can be argued. There can be people that get involved with the bank and the underwriting and the realtors that all say, no, that's not right. Let's look at the comparable sales that were used. So I think, to speak to Kathy's final thought on appraisals, if you are getting hard money, private money, it's called a broker price opinion, couple $100. It says, yeah, when we fix it up, we know it's going to be worth this amount. The neighborhood says so. And then for a bank, it's called an appraisal. You pay for it out of your own pocket. And the same thing goes. Is it worth what it's being sold for right now? And or is it not worth as much? And guys, keep this in mind. Appraisals never appraise for over what you're paying for them, other than by like $1,000, right around there, $2,000 max. Appraisals, you say to yourself, oh my gosh, I just bought this investment property. It's such a great deal. I know it's worth more. I'm getting a loan. No, it's not worth more. The bank is not going to say, oh yeah, you just paid $60,000 for that or $100,000, and I'm going to say it's worth $130 right off the cuff. You may know that, but it's not going to appraise for more. So don't be disappointed as an investor when you get your financing and you think you bought this really great deal, you know it's worth more, and the appraisal comes in at the value of what you're lending, what you're borrowing, or below it. And in that case, it gets negotiated out. This market is all over the place and the prices are really, really high, but it's in your favor as investors, because the last thing I want to say is on funding, no matter how you get your money, I have to say this. There's only one item in the history since mortgages were recorded in the 1920s. There's only one item that's continued to go up in value historically every single solitary decade, except 2 times, and that's land and property. Land and property is always going to go up. So even though we're in this big bubble right now, the only 2 times that property lost value, folks, was in the Great Depression and when the market fell and the banks collapsed in the fall of 07, 08, 9, 10, values tanked. But look what happened. They historically, as they have for over 100 years now, they rise in value. So no matter where your appraisal comes in, even though you're buying property at a top dollar right now, please don't let that stop you. It's not ideal, but don't let it stop you, because they're going to grow in value for sure. And the final one I want to talk about for funding your property that you buy is a cash out refi. That's really big. So when you do buy a property and it really needs repair and you're hoping you can make a ton of money off of it, but you plan on keeping the property, that is a cash out refi. So you buy a $100,000 property, you put $50,000 into it, but you know in your heart all the other homes in the neighborhood are selling for 250, 275. It happens. Those deals do happen. That's why people invest in real estate. So you go to the bank and you do a cash out refi, and the bank, same thing, they do an appraisal in the neighborhood. And since you're keeping the property, the bank is willing to send out an appraiser and say, oh, look at all these pretty things you did to this house. It looks fabulous. And they'll say, yeah, we're going to go ahead and give you 80% of the value of what we think it's worth, sometimes even higher, even 90. And they'll give you the difference of what you bought it for, what you put into it. They're going to appraise it, and you might walk away with $40,000. Guess what you're going to do with that? You're going to put it to buying and funding the next property. Okay. I know that's a lot, but I will put it in writing for all of you.
Now, I want to jump in and say we do have a mastermind group, and we are constantly putting more material into the mastermind membership site. So anyone that is interested in that, just contact me or Stephanie, and we can give you the details on how to get hooked up with that. There are some mastermind members here today in this group. And what we're doing is we're putting forms, we're putting price list, we're putting recommendations, all kinds of resources in that mastermind group for everyone. So just so you know, that's out there. I want to ask Stephanie a question and talk a little bit about this. When you were talking about FHA, where you and I, we each bought our first property and then we lived in it, and then down the road, we decided to hold it for rental as we pulled, I did at least, pulled some of the equity out, and that's how I got into my next property. But one of the things that you can do, especially if you're not a homeowner now, right now, and you're wanting to get into investing in real estate, mention what house hacking is, because in a house hack, you can actually buy a duplex, a triplex, and Stephanie, correct me if I'm wrong, even a fourplex, and still get an FHA, VA, or a type of government funded loan where you're still getting a low down payment, and you can have a lower credit score and actually get involved in real estate investing by house hacking. Talk a little bit about that.
That's true. That's accurate. And just to restate, house hacking means that the building that you buy can allow more than one occupant to live in the building with separate front doors. So it may be a duplex, it may be a triplex, it may be a quad. You live in one piece of it and you rent out the other 3 properties. Now, the amazing thing is, this is so unbelievable that I'd love to talk about in funding. When you house hack, you typically say you're buying a $100,000 house. It's got 2 sides. And you, in this market, guys, if you don't have a 6 in front of your rent, no matter what, I don't know what you're doing. I don't know. Even a studio, a 1-bedroom. So if you buy a property that's a duplex, you can use an FHA loan. You can do a USDA loan, which is rural development in a country area, not very populated. You can do a veterans loan as well. So you can buy it, live in one side, rent out the others to build money in your pocket. The rent that the others are paying you should cover your mortgage. I have to speak to something huge. That's such a way for everyone to start. Guys, right now, anyone that does decide to get an FHA loan or a veterans loan or a rural development loan, there are 5 or 6 different free grant programs out there right now that give you either your down payment or a portion of your closing costs. It's given to you at the closing table by FHA, USDA, VA. They're all federally insured, federally backed, underwritten loans. And I'm going to say to you, if any of you are a first responder, if you're a veteran, if you're a school teacher, if you're in the healthcare field, if you're on the front line, if you're a recent graduate of a technical school or college, then right now, I know of 6 off the top of my head. And without going into detail, let's say you decide to use a FHA loan to buy a duplex. You also can get 2.5. The required down payment is 3.5. So you can get 2.5 of your 3.5% down payment given to you at the closing table. So let's just say you get really crazy, and it still happens. You can ask the seller, because you've got to have a lot of money out of your pocket to close on any loan. You do, but you keep making it less and less and less. FHA, you got to have 3.5% out of your pocket, but you also have to pay your closing costs on a $100,000 loan or any loan. They're from about $3,500 to $4,500 are your closing costs. It used to be way back in the day, you could roll your closing costs into your loan. You cannot do that anymore unless it's, for example, a veteran loan, a VA loan, or unless it's a rural development loan. But if you buy FHA and you buy a duplex and you need 2.5 of your 3.5% down payment, that's cash. You live in one side, you want your payment to be $600 a month. That way your rent from the other side covers your mortgage itself. You can get grant money for free right now. And if any of you have no idea like where to even start with that, OFA is the main grant lender in Ohio. It's Ohio Housing Finance Agency.gov. It's OHFA.gov. OHFA.gov lists right now the 6 grants that are available for your down payment and your closing costs. And you can use that FHA loan. The credit score is back to about 620, 640. You can use it to buy a duplex, and you can live in one side, rent out the other. You can still get the grants that I'm talking about. And just to throw one more thing on top of that, you can get a rehab loan too. So if that duplex needs rehabbed, you can get a rehab loan with that product as well. It happens to be called a 203K or a 203B rehabilitation loan. So another way, still, if you just don't want to pay 12% and you don't have 6 months payments in your pocket and you don't have 4 points, $4,000 up front, then these are just, go down to the bare basics, get a typical old loan from a lender and start that way if you have nothing else, which is a good way, which works great actually.
Now, I have to go back to what Brooks was saying earlier. If you have a house already and you're building some equity in a home that you own already, one of the first things that I would do, and I have, this is how I got started, was doing the line of credit out of my current home because I had already built some equity. So I'm kind of lending to myself, if you will. I'm borrowing my own equity out of my own house, and I'm just getting a bank to underwrite that. So that's a great way, to kind of piggyback. And I did that over a 20-year period. And I would say about every 2 years, I could buy another property because I had enough equity. And then, of course, we won't get into that in this call, but you're allowed so many loans. And of course, in Ohio, you're allowed more. It used to be 4, but you're allowed more. But a lot of lenders are still sticking to the number of 4. And that's where a portfolio bank comes in really handy because they can portfolio 2 or 3 properties together and it becomes one mortgage. So now you can actually have 4 of those groupings for the banks that want to stick to the 4 loans. So there's that piece of it too. I'm also going to jump in and give ourselves another little advertisement. In our mastermind, there is a course that is included for all mastermind members called the 6 F's of real estate, and it goes through the finding, funding, fixing, flipping, filling, and finally the freedom number. And in the funding section of that course, all of these loans are spelled out there as well. So I'll just toss that out there that's part of the mastermind, and it's complimentary with your mastermind membership. So I'm going to open it up to questions.
Can I just please let everyone know, this market being so high in value, for those of you that have a home that you own and you really think you have no equity, you probably do. This market is so extraordinary and the prices are so high. You think you have no equity in your home. Maybe you haven't checked because you're pretty sure you don't have enough. You would be in disbelief that to do a refinance, to take cash out of the equity of your home, refi loans are where banks make money off your refi, guys. They want to do a refi. They want the money that they make. So they get you to refinance. You may have paid on it 2, 3, 4, 7 years, who knows, 11 years, however long. And you will do a refinance and all the homes in Columbus are going for top dollar. This is in your favor right now. Take advantage of it if you have a home. Take advantage of it and try to pull the cash out of it. Even if you don't know if you have it, chances are you do.
I want to open it up for questions. Who has a question for Stephanie? Either press your space bar if you're on a laptop or desktop, or use your mouse, or depending on what you're on, you want to click your mute button so that we can hear you. and unmute yourself. So does anyone have any questions?
Hey,
I went
Stephanie, I had a
really long.
question.
Yes.
I'm new to the broker price opinion thing, and that sounds really interesting, especially in this scenario that I'm looking at today, where I can't get a really good comp on what I need, and if I want to prove that price to the seller, just so that we're on the same page, like, hey, I know you think you're here, but really we're over here. That sounds like a really good option. And so first, my question is that can anybody is that something that has to be ordered through a real estate agent, or can I call anybody? I can call a company to have somebody come out and look at that, and how much weight does that hold, number one? And the second part of the question would be, do you have anybody that you could recommend to get a hold of?
Sure, absolutely. A couple of things on that. If you heard Brooks, I do broker price opinions. Brooks does broker price opinions. Do they hold weight in water? Yes, because like Brooks said, we're on the front line and we know what's selling in a certain neighborhood. You can call any licensed real estate agent that feels comfortable. They're active enough in the market. They might do a lot near South Bloomfield. I know Chrissy Wallace does a lot in that area as well. And you say, are you willing to run comps for me? Can I pay you to run comparable sales for me? I know I've heard it's called a broker price opinion. And in fact, absolutely. It's actually quite easy. And the reason that Brooks could do it for you, even though he has no idea where South Bloomfield is because it's not really subjective. He's picking out the homes that match what you're trying to buy. He's picking out the closest sales. He's going to go back 30 days, 90 days, 6 months. He'll go appraisers, by the way, appraisers will go back 12 months on an appraisal for comparable sales. That's the furthest that they'll go back, unless it's such a unique property they have nothing to compare it to. So what a broker price opinion does is gives you 3 properties that are like what you're buying. Any licensed agent can do it for you. Most of them charge anywhere from $100, $150, all the way up to $300, $350, depending on how complicated it is. And it's given to you and you can present it. And just so you know, it sounds like you don't have a real estate agent, because if you did, your real estate agent would kind of be arguing the point for you that you don't need to pay that much. And the real estate agent would make a case for you and say, well, geez, he must be selling it privately, I'm assuming. And you're welcome to definitely get a broker price opinion on it from any licensed agent that does them.
Well, as a matter of fact, in this particular scenario, an agent brought it to me. And the agent so I actually had to contact the owner directly, just to kind of trying to work out a creative finance situation. And the agent we weren't talking the same language. So we kind of had to skip past her and go to that. But the idea that I'm getting is that the agent is the one who's touting this price that's higher than what I think is realistic. But she is very close to the house. I mean, she is in that market very much. And so, I don't know that I'm not going to argue with her. If that's her market, that's her market. She owns the building there. And so I would like to think that she's on top of it. But at the same time, I kind of felt like she was looking to me to come up with a price. And I really wasn't comfortable with it. And I'm wondering, if she's not on top of that market, how could somebody else, somebody who's not even associated with that market, how could you come up with a number that is concrete and something that you can stamp and say, we're really confident in this number here?
Right. That's a great question. And it is actually that easy to do it. I'm very familiar with South Bloomfield, but even if I wasn't, if you told me to run comps in another state or in another city, as long as I had access to their multiple listing service and their auditor site, I would be able to do it. I would look within a radius of surface area, and I would look within the same age range, number of bedrooms and bathrooms, same style of level of finishing, whether it's over the top or whether it's just a medium finish, a little bit dated, a little bit not. I would actually look at all those factors, and I would come up, I'd probably have 20 properties to choose from. I would narrow it down to the 3 closest ones, and I would give every side-by-side comparison: number of bedrooms, number of bathrooms, number of stories, floors, number of acreage, the age of the home, the how old's the roof, how old's the siding, what's the condition of the home. And then when you look at the 3 most recent sales going back 30 days, 60, 90, 6 months, and you look at this, the ones that match the closest and the ones that are the most recent sales, that's the exact 3 that you use for the broker price opinion. It all goes into a spreadsheet. There actually is a form called a broker price opinion, and it's provided to you, and you say, look, here it is. I don't even have to live in South Bloomfield to say, here is my broker opinion of the price of the home. Now, I want everyone here to know the #1 rule in real estate. Guys, real estate, the value of real estate is what a person is willing to pay within reason. I feel like Susie Orman here right now, but real estate is worth what someone's willing to pay within reason. So quite frankly, if you are like, gosh, I'm not willing to pay that because I just don't see the value in that property, and nobody else, keep this in mind in this market, nobody else is buying it out from underneath you, sounds like it might be a little overpriced to me.
Stephanie, I have a question, and this is pertaining to Ryan's. This is pertaining to Ryan's question too. What happens if this is in a small town? This is the only property that's for sale in that downtown older area. All of the surrounding area is all new builds and all have a higher price. And how do you come up with comps? Do you actually go to another small town, you know, a little ways away to find like properties? Wonder if you can't find a like property within that little community.
Absolutely. Yes, that happens. Yes. And I'll go from this, just like the property that we're talking about, just like the property that we spoke of earlier that came in 6,000 low on the appraisal, the quad, just like some rich person has a recording studio that's worth $2 million, but there's no other $2 million properties anywhere around it. What you do when there's not a comparable sale within the radius of area, and what you're looking at, guys, is you're looking at school district, because you might have this same house sitting in Upper Arlington, the exact same little crappy house, but it's sitting in Hilliard. They're both 3-bedroom, or I'm sorry, Columbus is what I meant. They're both 3-bedroom, 1-bath ranches, and one's in Arlington and one's in Columbus schools. Whole different world in terms of what they're going to appraise for. Obviously, a lot of things go into play. So you want to stay within the school district, you want to stay within the area, you want to stay within all the other factors. But when you cannot find anything, nothing that is comparable, you have to turn it over to the expert, which is the appraiser or the realtor. It's called as the crow flies. You go into other small communities. This is an example. Let's say South Bloomfield. Okay, that's great. Let's just say that there's absolutely nothing like this factory that you want to buy. There's nothing like it anywhere, but there really are these other factory style properties that have sold, and one of them is outside of Lancaster. Let's say it's in Logan, for example. Let's say one is in West Jefferson, Ohio. As the crow flies, if it's an extremely unique property, you go to other smaller areas. As the crow flies, the mileage, guys, you don't know this, but you can get a lot further as the crow flies than you can taking typical mileage, because appraisers have to stay within mileage. So it turns into a Google search as the crow flies. You go into other non-populated smaller markets and you look for the similar style investment or factory or house, or whether it's a richy rich house or whether it's a little poor dumpy house. You go to the neighboring small towns, and school district still does come into play. So South Bloomfield, we all know we can run school district ratings. We all know that. That's easy to do. So South Bloomfield would be a great comparison to the places I mentioned, like, for example, West Jefferson, for example, like Sugar Grove. You know, those are great examples. They're good comparisons for school district and good comparisons for small rural towns with little downtown areas with a property just like what you're talking about.
That's the conversation that Ryan and I had earlier, and I said he might have to go to an adjoining small town that's very similar, because oftentimes when one of those properties comes up for sale in the heart of one of those little villages, there isn't another property that's been sold in the last however many months, so it's hard to get comps.
Yeah, it has to be really, really unique to go the distances that I just spoke of. It has to be really unique. But if this is just a typical older downtown building, I'm sure there's going to be comps in Circleville, in Lancaster. There's no doubt in my mind.
Okay.
Yeah.
Thank you.
Yeah, you're welcome. No problem. You're welcome to email me. I mean, literally, I could run a BPO so quick. Anyone can that's licensed and is active in the market. It's really not hard. But in this market, with every property having, you know, if a realtor brought it to you, every property has upwards of a dozen offers on it, almost every property. Inventory being down to 1.1 month. If it's not sold, it's overpriced. I have no problem telling the entire group that it's overpriced. Yeah. Or it'd be sold.
So Ryan, your gut instinct is correct on this one. You're thinking that the realtor has it a little overpriced, and it sounds like maybe it is.
Okay.
Yeah, so it'd be worth some due diligence and some homework there, so that you don't pay too much.
Yeah.
Because as an investor, that's the first thing, is you don't want to overpay.
Right. Yeah, that's the whole game.
I have a question for Stephanie.
Go ahead, Terry.
So, when you were talking about the different loans to get, because I'm trying right now, I don't know if you have any coming, or, you know, I'm in real estate, and my daughter's looking for a duplex. And I've never really done a lot with rentals or duplex or anything like that, but you were talking about different loans like the OHFA. Do you have to make us, I always thought to get those grants or loans, you have to be under a certain amount of money you make yearly. Is that true?
That is true. Yes, Terry, that's totally true. And the threshold, I'm going to give you one example. For the OFA loan, Ohio Housing Finance Agency, there are these grants for recent graduates who they're recent graduates, so they really have almost no income. But then there's also high level caps too. So for the standard Ohio Housing Finance Agency grant, the single income, if your daughter is not married, is $56,000. And if she has any deductions at all, she can't, I mean, it can't go over 61, just so you know. 56,000 is the limit, but if there's special circumstances of some sort, it can be 61. When you're married, it's 98 and 102. So if she were married, then those income caps go to 98 and 102. And that's where the values are for the OFA grants. Yes, okay. You're absolutely right. So glad you asked. And there's a retention for those, Terry. The retention is 5 years, but can I let everybody know something? Go for a grant. And here's why, Terry, because nobody ever checks to see, nobody that gets an OFA grant. Strike me, but I'm dead serious. I've been doing this 19 years. And I use the #1 OFA lender in the state, Stuart Spalt. I use them all the time. Nobody ever goes knocking on the door checking to see if you're still living there 5 years later. Because there's a retention period that you have to pay back the grant money. If you move out or sell it in under 5 years, you have to pay the grant money back. No one checks.
Right. So she's going to be done with school. She's in PA school. So she doesn't actually have a job, right? You know, she will be done in December. So
she totally qualifies for the recent grads because you don't have to have graduated yet. You have to be graduating within 6 months.
Wow.
Yeah.
And who would you use for that? Like, who are you guys using? What lender? Because my lender didn't tell me any of this that I use.
Guess why? I can guarantee you, Terry, that your lender, bless their heart, they may be fabulous, but they might not be a licensed OFA lender, Ohio Housing Finance Agency.gov. You can go to OFA.gov and look at a list of licensed agents. I personally, you please feel free to write it down. I use Stuart Spalt for all my grants, every single grant, and it's www. He's with American Eagle Mortgage Corp in Westerville. He has an office in Westerville, and he has little satellite offices everywhere. I don't make $5 off recommending him, but Stuart, yeah, it's www.American Eagle MAEMC American Eagle Mortgage Corp .cc, not .com, .cc /Stuart, STUART, www.aemc.cc /Stuart. He does all the grants. He's the licensed grant guy he's the #1 OFA lender in Ohio, and just a really great guy. So I'd give him a call and run everything by him, and he's going to give you great news, Terry.
Oh, thank you. And in Westerville, and I'm in Westerville. And it's okay. Last question. Do you ever have duplexes, or you have anything coming where you're listing?
What's amazing is that I don't know if anyone knows this, that people that look on the open market on the internet to buy duplexes, this is huge, guys. When the law passed in February of no more pocket listings, right, all of you that are looking for duplexes and rehab and investment properties, you're all looking like, oh, I want to try to get this private deal, and I don't want to look in the MLS because I want to try to get something that's not on the market. Well, quite frankly, I do have my MLS search set up to immediate to the second. It's called ASAP, and I have a duplex only search. It's called multifamily, and it's multifamily, and it's minimum of 2 units, or I can do 2 to 3, or I can do 1 to 4. But I actually have an automated search that comes to me to the second. If a duplex comes up anywhere in all of the greater MLS for Columbus and all the greater, it goes all the way to Zanesville, goes quite far. So that's how I do it, Terry. And to be frank with you, I actually don't have like those back pocket items that you're talking about now. Those are much farther and fewer in between for exactly that law.
Right. And that I just meant you might know that you have something coming up. I'm not saying, I know you can't, I know with that new law, you can't say where it is or when or something like that, but I just wondered.
You can't. Isn't that crazy? I can't tell you, but guess when I
well,
can.
You know what? There was a guy, I talked to someone the other day, and he did tell me, he even gave me the subdivision. I know he's not supposed to, but he wouldn't give me the address. So
he can give it to you 24 hours ahead of time. He can give you the address 24 hours ahead of time. Guys, the other day I had a pocket listing and I had 11 minutes left. 11 minutes to get signatures on the contract. Otherwise, I could have been turned into the Ohio Division of Real Estate. There's a complaint line set up. I had 11 minutes left. So Terry, that's awesome that he told you the area, but that's great that he's being ethical, because a lot of people aren't being ethical. But hook back up with him, because he can tell you where it is 24 hours ahead of time.
Well, it's not going until next week, but yeah.
Good.
So so thank you.
You're welcome. My pleasure. No problem. You'll like Stuart.
For those of you that are searching for whatever your filters are, your parameters are, let Stephanie or even Terry or even Brooks know what your search criteria is, and they can set you up on a criteria right on the MLS where they'll send you that information as soon as it hits the market. You'll get an email with all the duplexes or all the multifamilies or all under a certain price or all in a certain zip code area. They can set those up for you. And Stephanie works with the Happy House Hunters group, but we've got some other realtors. Of course, Brooks was on, and then Terry is also in real estate. So feel free to contact and get some of those searches set up for yourself if you're actively looking to find property. Any other questions for Stephanie? I know we went over some. It's already 7:42. Can you believe that? We started a little bit after 6. This was a long call, so I apologize that we went so long, but it was such great information. Again, please connect with us. You can go to kathybinner.com. There is an interactive calendar right there on the website. You can either scroll down the home page or you can go to the menu bar and find the calendar. All of our meetings are on the calendar with the Zoom code, so you know when to tap in, what time, what date. And then once the Zoom call is over, I go back and post the replay. And so sometime tomorrow, this replay will be posted. So if anybody has friends or family that you want to listen to this call, or if you want to listen to it again, you can go and listen to the replay. If it's something that we do in the mastermind group, that is put specifically in our mastermind membership site, and only mastermind members can get to those calls. But You are welcome. I do have the Zoom code to tap into the mastermind. Anyone that wants to visit the mastermind before joining, you are welcome to tap in and listen to a couple of mastermind calls and see if it's for you before you decide whether you want to join or not. And then if you do decide to join, you do get access then to the whole membership site. So I will toss that out there. Stephanie, I'm going to check. There's a couple chats. I'm going to check and see what those are. Do you have any final comments you want to make?
No, guys, thanks so much for listening. And it's such an unbelievable market. And any questions that you have, I'm happy to answer. My website is stephaniejenkins.net. stephaniejenkins.net is my website. And my email is stephaniejenkins@remax.net. And I'm so happy to listen to. I really love what I do with all of my being. And if you have a scenario that you want to explain to me, I am more than happy to help you out in any way that I can. No obligation at all. I love what I do, and I'm happy to help you sort anything out that you need.
Okay, Steph, can I need a couple of answers. Can you help me out a little before you go?
Sure.
Yes, I'm Kofi. I'm a recent graduate from the Ohio State University, and I'm going to real estate investing. The good news is that I have a property now in Cleveland that I'm working on now. And then I've actually got a lender. I didn't know I could. So you've opened my eyes to so many information right now that if I had heard earlier, I would have probably been better off. But I have a lender now, and he's promised, I think, 90% of the cost of the building, the cost of the property, and then 100% rehab. And he's well, there's so many fees involved that but after everything, I think I'll still make some profit, so I'm good with that. But I guess my question is, as an early graduate, a recent graduate, what are some of the financing options for me? Like you stated that I heard you mention a couple of them. And then the other thing is with the rehab, since it's my first deal, I'm actually I have a contractor. He's giving me a fixed amount of money, like a total cost of the rehab, but he's asking for half of it now, another a third or so after his middle way, and then the full of it, and the full amount after it's completed. But my question is, I want to be part of the process. I mean, because it's my first deal, I want to be part of the purchasing process, so I get to have an idea of how much this cost, how much that cost. But he's asking for the money, half money up front. So what do I do? Do I go and buy the things for him, or I give him the money up front so that he purchases everything, or advise me? What do I do?
Well, a couple of things. If I'm understanding you correctly, number one, congratulations on being a recent graduate, and congratulations on starting young in real estate investing. You're so smart, very, very smart. And if I'm understanding you correctly, you're getting a loan right now where someone's giving you the money. You're getting a rehabilitation loan, but is your contractor asking you for money? Is that what you're saying? So
the cost of the property is 90%. So when I'll produce a 10%, that is settled. But you know, the rehab cost, you have to do something before you actually ask for the rehab money. He's ready to finance the 100% of the rehab. But what he wants is that when you do something, you have to actually start something, show proof of what I've done before I can actually tap into that money. So what I want to do is I want to be part of the process. So I want to actually go with the contractor to buy everything that he needs so that I get to understand, have an idea of how things are. But what he's also asking is that he is giving me, he said it's 27,000. He's taking 13,000 up front. And then halfway you take another 6,000, and then at the beginning you take, at the latter part, he's going to take the rest. But I want to be able to talk to him and convince him that, hey, I want to purchase the things for you, and then I'll just pay your labor cost, as it were.
Okay. Couple of things. Number one, guys, what he's talking about is draws from the bank. The bank will give you draws on a rehabilitation loan where they give you out money in segments for the work to be done, and then the bank sends somebody out to look at the work that's being done to approve it before they give you more draw and more money for your rehabilitation cost.
Okay.
That is how that works. You have to prove that work has been done at each level of the draw. Now, Kofi, what I will say is that there's absolutely, unless it's an agreed upon written agreement in the contract, the money you're getting is to begin the work on the property. And yes, of course, you definitely, it sounds great. If you want to offer to help out and watch what's being done and learn how to do it and be a part of the project, that's a phenomenal idea. But I will tell you this, there are lenders, guys, I want everyone to know this too. There are lenders that will not give you money directly to you to rehab a property. You have to be a licensed contractor. The money is released to a general contractor. You can go in there and help out, and you can do some leg work and some labor work, but the money is released to a general contractor. And so a bank is not going to give that money to you directly in your personal account for you to rehab a loan. So that's one thing. The other thing is great to be a part of it. The third thing is the money you're given. If you have no money to start the rehab project, Kofi, the bank shouldn't be asking you to prove that you're at a certain level because the reason you need the money is to do the rehab.
Exactly.
So shouldn't you, that's completely non-standard. A bank should not be asking you to prove that you're at a certain level unless you agreed that you were going to fund 30% of the first 30% of the rehab. Unless you agreed to do that, then the bank should not be asking you to prove that you have a certain amount done. Sounds to me like maybe the bank thinks that they have asked you to prove that there's a certain amount done. And it sounds to me like you're wondering where you get the money to even start.
Exactly. So like you mentioned the draws. I think exactly what they mentioned, but how do I even start in the first place to be able to, well, get to a place where I can make a draw?
You don't. I'm going to be really frank with you that your scenario is the absolute first time in my 19 years that I've ever heard of getting a rehabilitation loan where you have to magically, the money to rehabilitate is the money that you use to start the rehabilitation. So there is no part, like you buy the property, secure the property, and then money is, once you have access and keys, you get your first draw, and that first draw is typically used to secure the general contractor given to him and to secure the labor and to secure the materials. The first draw is always for materials to start the rehab project. I'll add into that. The second half of a first draw is for demolition. If there's any demolition that needs done, you're not expected to do that out of your back pocket if you don't have the money to do it. The draw system, and it's usually a 5 draw, just so everybody knows, it's a 3 to 5 draw. 3 on the low level, 5 on the higher, and an appraiser is sent out at every step to verify the work is done, a type of appraiser. So Coffee, you shouldn't be being asked to kickstart the rehabilitation. That's extremely non-standard unless you agree to it in writing and you don't realize it.
Okay.
I would say the first thing you need to do is actually go back to your contract and actually read what your loan contract says, and just look at what the details are there as to what you're responsible to do at which level of the draw. Are you doing the financing from a bank, or is this a private lender?
It's a private lender.
Okay, so that's probably why, is it's not the traditional bank loaning you the rehab. So I would have to go back to the paperwork and see what actually you agreed to do on a legal binding contract. That's where you need to start and see what it says your level has to be in order to get these draws.
Okay. And then the other thing is, you have done a lot of rehab. So which is preferable, giving the money to the contractor to go ahead, or, I mean, having access to the money that as and when he needs it, he comes to you?
Well, this is a pretty easy question. It's based on skill level, and it's based on who's doing the work. So the first thing that you want to do, you're the rare person that wants to get in, you want to get involved and help out, and you want to learn. The money on the draw, which is better, is this. It's better if you have a relationship with a general contractor who, let's say your draws, the general contractor is part of the contract, the draw money is going to be given to a general contractor that you specify. But because, because you're doing a hard money loan, Sounds like this is a private lender, a hard money loan. It sounds
Or
like
private money, may not be hard money, maybe private money.
Private, yeah, trusting you with it. It comes down to that contract, like Kathy said. It's great if you can save money by doing a lot of the work yourself and proving that the work is done. That's fabulous. But if you have a general contractor that you're using that's licensed, the lender typically gives the money to the general contractor to hold in an account, and then you work out a deal behind the scenes and on the side to tell the general contractor that you would like to do as much work as you can, and you would like to learn as much as you can beside him and his crew.
Okay. Good to know.
So the money, you're not paying the general contractor to do every little thing. You're trying to save money by doing some work yourself.
But on the other side of that coin, the contractor now has a liability issue of having someone on the job site that's not an employee of his. So that also becomes an issue. So yeah, so there's some other factors to figure in there.
Gotcha. Thank you very much.
Any other questions for Stephanie? I know we've gone long, so I'm going to close out unless we have some other questions, comments, or questions from anyone. I'll give just a second to go around. Okay, it looks like we're all set. Stephanie, thank you so much. I appreciate your time tonight. This was invaluable information. I love it. I learn something new every day. I've been in the business for over 20 years and I still learn something on every one of these calls. So thank you so much. I appreciate everyone else being here. Again, I can start putting a lot of dates out to you, but if you go to kathybinner.com and go to the calendar, all of our events and dates and everything will be right there on the calendar. So check that out. If you need to get in touch with me or with Stephanie, either one of us, feel free to do that. And if we can give you some information, copies of anything we've talked about, let us know. We're happy to forward it on to you. Okay, with that, I'm going to say good night to everyone. And again, thank you so much for joining us today. So we will see you soon.
Great. Night, Kath.
Thank you.